Hey, welcome. So, if you've ever felt curious about financial trading, but, found all the jargon a little bit much, well, you are in exactly the right place. Today, we're going to break down the absolute fundamentals to give you a really clear, straightforward look at what trading is all about. So, here's what we've got on the docket. We'll start with the big question: what even is trading? Then, we'll get into the mechanics of margin, explore different markets, and then, this is a big one, learn how to read those candlestick charts and spot some key patterns. And to wrap it all up, we'll talk about the risks versus the benefits. All right, let's just jump right in. But first, we need to start with a serious reality check. That number you see, 71%, that's the percentage of retail accounts that lose money trading CFDs, according to IG, which is a major trading platform. Now, I'm not saying this to scare you off, but it's so important to understand why getting the fundamentals, and especially the risks, is absolutely crucial. Okay, so let's start at square one. What are we really talking about when we say trading? Because, it's a bit different from what you might think of as traditional investing. This right here is the most important thing to get. Trading is not about owning a piece of apple or a bar of gold. It's all about speculating on which way the price is going to move. Will it go up or will it go down? That's the game. If you guess right, you profit. If you're wrong, you lose. Simple as that. So the tool that makes all this possible is something called a derivative. Its price is literally derived from an actual underlying asset. So think about it. As the price of a meta share goes up and down, the value of a derivative that's based on that share moves right along with it. And with derivatives, you basically have two main moves. You can go long, which is just a fancy way of saying you're betting the price will go up, or you can go short, which means you're betting the price is going to fall. And that ability to potentially make money when a market is falling, that's a huge difference between this kind of trading and traditional investing. So you might be asking, how can I trade these big assets without, paying for them in full? And that leads us to a really powerful and, risky concept: trading on margin. This is all about something called leverage. Leverage is what lets you control a really big position with a pretty small amount of your own money. That small deposit you put down, that's your margin. And this right here is the classic double-edged sword of trading. Leverage amplifies everything. It can make your wins bigger, but it can also make your losses bigger and just as fast. Okay, let's walk through an example to make this real. Let's say you want to control a position that's worth $1,000. Well, if the margin requirement is 20%, you only have to put down $200 to open that trade. But, and listen, this is the most important part, any profit or loss you make is calculated on the full $1,000, not just the $200 you put in. Okay, so you get the basic mechanics now. But what can you actually trade? I mean, there are literally thousands of financial markets out there, but they pretty much fall into a few big categories. Right, you can trade shares of individual companies or dive into the Forex market, which is all about exchanging currencies, like the euro for the US dollar. Then you have indices, which let you trade on a whole bunch of stocks at once, like the S&P 500. And of course, there are commodities, physical stuff like gold and oil or even coffee. Okay, let's say you've picked a market. How do you actually figure out what the price is doing? Well, one of the most popular tools that traders use is something called a candlestick chart. And here's a pretty cool piece of history for you. These charts are not some newfangled invention. They were actually developed by a Japanese rice trader named Munehisa Homa way back in the 18th century. He figured out that markets are really driven by emotion, and he used these charts to get a visual on that constant battle between buyers and sellers. So, every single candle tells a story about what happened in a specific chunk of time. The main part, the real body, shows you where the price opened and where it closed. Those little thin lines sticking out, the wicks, they show you the absolute highest and lowest prices the market hit. And then, of course, the color gives you a super quick read on which way the price was moving. It's actually really simple. A green candle, that's a bullish one, means the price closed higher than where it started. Buyers were in charge. A red candle, a bearish one, means the price closed lower. Sellers were in charge. It's this instant visual that makes these charts so powerful for seeing what the market mood is. Now, a single candle is useful for sure, but the real power comes when you start looking at them together, because they form these patterns that traders use to try and guess where the price might go next. Let's look at a couple of common ones. So first up, we have the bullish engulfing pattern. You'll usually spot this after the price has been going down. You see a small red candle, and it's followed by a big green candle that totally engulfs it. It's a really clear picture of a big shift where the buyers just came in and completely overpowered the sellers. It suggests the price might be about to turn around and head up. And on the flip side, you have the bearish engulfing pattern. It's the exact opposite. After a price has been rising, a small green candle gets swallowed up by a big red one. This is a sign that the sellers have wrestled back control, and it could be a warning that the price is about to start dropping. And here's one with 3 candles, called the Morning Star. It starts with a big red candle, then a small, kind of indecisive-looking candle, and it finishes with a strong green candle. This whole sequence suggests that the sellers ran out of steam, and now the buyers are jumping back in with a lot of force. It often signals a potential bottom in the market. We've gone over the what and the how, but now we have to circle back to what is easily the most critical part of this whole conversation, balancing those risks and benefits. You know, the biggest takeaway here is that pretty much every single benefit in trading has a matching risk. That leverage that magnifies your profits, it does the exact same thing to your losses. Short selling is great because you can profit from falling prices, but since a price can technically rise forever, your potential loss is unlimited. And yeah, all that market volatility creates opportunities, but it can also wipe you out with a sudden, unexpected move. And just one final, really vital point about those charts we looked at. Candlestick patterns are great for getting a feel for short-term mood swings in the market, but please remember, they are not crystal balls. Relying only on them is a huge mistake. They're most powerful when you use them to confirm signals you're getting from other types of analysis. So we've laid out the groundwork, right? You know what trading is, how leverage works, how to read some basic charts. But all of that knowledge just leads to the single most important question you have to ask yourself before you even think about placing a trade. How will you manage the risk? Because that, right there, is the foundation of everything.